So what is the doubt now? Module
So
quiz?
second question, 7.2. Second question.
Okay. 7.2 question number?
Second.
Okay, question number 2, this one.
Yeah.
Okay, it's a case study. Use the following information to answer questions from 1 through 5. Kirk company acquired shares of both company A and company B. We have the following information from the public market about company A and company B's investment value at the time of purchase at 2 subsequent dates. Okay. So this is the price at which they purchased. Now, at P is equal to 1, Kirk will carry the financial assets at cost, write down the financial assets to 1030 and recognize unrealized loss of 170. Write down the financial assets to 1030 and recognize a realized loss of 170. Okay.
So I marked it as C.
Okay, fine. We'll do this sum now. So, initial investments, company A and B, acquired shares of company A and B. Achha, overall, we have to calculate both. So, initially, balance sheet at time 0. So, asset A will be 9. So, all these are public price. Okay. So, it is 950. And for B, it is 250. Okay. At time 1, okay, so at time 1, company acquired via the following informations of investments value. Investments in financial assets. Okay. So at time 1, only fair value is given in the market. So it will be either yeah. So it will be either hat table if we do, trading. So fair value through OCI, realized gain, unrealized gain, fair value through profit and loss, realized and unrealized. Okay. So they have not mentioned whether it is OCI or this one. Okay, but anyways, the question is just about realized and unrealized. Okay, that doesn't matter then. Okay. So fair value is 850 here. So asset A will be 850. Then asset B will be 180. And then profit and loss perspective, realized gain, okay, or income statement perspective, realized gain is that is also we don't know, but we know unrealized gain we can calculate. Unrealized gain will be, or unrealized losses, no, here. So unrealized losses is, okay, because this is all
Difference between
equities,
them.
yeah. So how much
But
is
sir,
this?
this is
100.
realized, right?
100. No, no, no. Because these are shares, not bonds.
Okay, so there are.
These are shares, na. This is completely unrealized only.
Okay. In
Okay, so
bonds,
this is
these differences realized.
correct,
Okay,
correct.
then it's okay. This
There we
was only
calculate the
different.
amortized value. Here there is no amortized value, and here it will
70.
be 70. So unrealized is 70 loss. 170. Okay, both the sides it is there. So which
Yeah.
one then? And this is written down value is 1030. Is it? This is matching to
Yeah. Yeah.
1030. And this is recognized as an unrealized loss. Recognized as a realized. Okay, no, this is unrealized because these are shares, not bonds. Understood?
Yes, sir.
Okay, so the answer is B. Yeah, what is the next one?
Fourth.
Based on the information provided, which of the following statement is most accurate? Which of the following statement is most accurate? Which are the following? Based on the following information provided, which are the following statement is most accurate? Classifying shares as fair value through profit and loss would result in greater reported earning volatility. For profit and loss, classifying through profit and loss would result in a greater reporting earning volatility. Yeah, this is possible because all realized, unrealized will come under income statement. So more volatility is possible. But let's see other options. Classifying the shares as fair value through OCI would result in 220 realized gain for between T1 to T2. Okay, that we have to check. So time to balance sheet asset value will be 900 and 350. So this is 9, 10, 1250. 1250. Then, so what is the difference? This one. But they said realized, na? So there is no point of checking also.
220.
These are all unrealized only. So this will not come only, okay? The next one. It is optimal for Kirk to classify its shares in company A and company B as fair value. Fair value through profit or loss. Since its results, it's optimal for Kirk to classify its shares in company A and B as fair value through profit and loss, since it results in 50 uh, 50 gain recognized on the income statement at time 2. Okay, so that also then we have to see unrealized gain will be how much. So here income statement unrealized gain will be,
220, right?
what is the difference?
220.
Is it 220? 1030 minus
Yeah.
1250, 220. So 220 will be gain, unrealized gain. This is loss. So 220.
It's wrong.
Yeah, but they said 50, right? So
Yeah.
that is also wrong.
So can you explain first one again means A, option A.
Yeah, classifying the shares as fair value through profit or loss would result in a greater reporting earning volatility, because be it profit or loss, you are going to report now all that in income statement only. So more volatility will be possible now, right? More volatility will happen, because if you would have reported all this in the OCI, then this volatility will not take place only. Is it okay?
Yeah, okay, sir. So only difference between when we are doing for shares and debt is it's realized and unrealized gain and loss.
Yeah, yeah, yeah.
So in the fifth question, it will be same, right?
Okay, let me see fifth
Yeah.
question. Suppose that for this question only, that security A and B are both debt securities carried on at amortized cost and purchased initially at par. Okay, at time 2, it will report the carrying value of the securities at. Okay, carrying value of the security. Carrying value will be, uh, this is the carrying. Acha, see, carrying value, they will have fair value only. So this is the fair value 1250. So 1250 is the carrying value.
So B is the answer.
B
Yeah.
1250. Uh,
So should I read the answer?
no, 1 minute. Let me think why first of all. 900 and 350. And initially purchased at par. That means you are holding the bond maybe till maturity you are holding. Is it? Yeah, because that is the life of the bond. So if that is the life of the bond, it will be thousand. Finally, it will reach to the par value. No, then it is not. 1 minute.
1200.
Par value means 950 and 250. Sorry, 950 and 250. This is the par value, no? So it will reach to par value at if I
1200.
think this as maturity, this as maturity, then it will come to 1200, no?
We
Is it
will
okay?
report only cost. It's like that.
Uh-huh.
We will report only cost, like 950
Because see,
plus 250.
finally it will reach to the par value. We don't know anything about coupon. So coupon we are not bothered. So if you are purchasing this at 950, okay, this one, after whatever number of years, it will reach to 950. In this case, 2 years. So after 2 years, it was to reach to 950 only, right? Understood or not?
So why it will reach to 950? It will reach to par. So 950 is par.
950 is par. How do I know 950 is par? They are only saying initially purchased at par. So that par is on 950 and this is 250. So it will reach to 250.
And they've asked that like at T2,
Hmm.
what will the carrying value?
At T2, the carrying value is 1200 total. It will reach to par value. It will become 1200.
It's a little bit confusing.
Not okay. Not clear. See, okay. Think that instead of 950 and 250, think you invested in two stocks. One was 1000 and another one was 100. Both are for 2 years, and you purchased at par value. Okay, there is no coupon. You don't know about coupon now. So what do you think will be the par value after 1 year, after 2 years? It has to reach to 1000 only.
Yeah.
You don't know about coupon, so you leave that coupon. Here it will reach to 100. So what will be the carrying value after 2 years? It will be 1100.
Okay. So sir, this is carrying value is 1200 and the fair value is like 900 plus 350.
Correct.
Okay, that's fair value.
Ha, ha. Okay. because they have given you conditions, na, that you are purchasing initially at par.
Hmm.
So that means that amount means what? This is par. If this is
Okay.
par, it will reach to par.
Okay, so if they didn't give that we are purchasing at par, so then let's assume the par value will be thousand. Then the carrying value is 2,000, right?
Then
The
it will be
carrying value
2000.
is always that
This is 1000
par.
and this is also 1000, you are saying, correct?
Yeah.
Then it will be 2000. That's
Okay,
what
it's carrying
initially.
value.
Ha, ha.
Okay, okay. Understood.
Okay. Now we did only this topic, right? We didn't do equity method, correct? We didn't do the equity method. Okay.
We
So
have
now,
done like that 15,000 and that cash dividend one. Actually, you gave the example, I guess.
uh, we did, is it?
Yeah, you gave the question like 100 share of XYZ at the rate 150 per share. End of the
Acha,
year it
acha.
is 170.
Acha, acha. Acha, acha. Okay, okay. Now little bit bigger full-fledged sum we will do
Yeah.
for equities. Okay, equity method here, this one. So I will do one full-fledged sum. Okay. So I'm going to write the question here. See, this is for equity method. Okay. Equity method of accounting. Imagine there is an acquirer. This is acquirer's balance sheet. Equity is 5,000. Retained earnings 3,000. OCI, other comprehensive income 3,000. Minority interest. What is this? All you will come to know. Minority interest is 2,000. Then book bank loan 7,000. Goodwill 3,000. Building 2,000. Cash 15,000. So here 20,000. Okay. Then target company. Equity retained earnings 2,000. Then OCI 1,000. Bank loan 6,000. Goodwill 2,000. Then property, plant and equipment. Here, this is land 2,000. I didn't do this sum last time.
No, sir.
Building 2,000. Inventory 4,000. Okay, and total comes to 10,000. 10,000. Now its market value is think 10,000. Its market value is 12,000. Okay. And depreciation, straight line method, depreciation for 10 years. Okay. So, and here acquirer acquires 25% share, okay, at the rate of 9,000. Okay, so here 9,000. Okay, and the first question is prepare balance sheet of the acquirer post acquisition. Decompose the purchase price of 9,000. End of the year, income statement of the acquirer. Ignoring investment account. Days sales 10,000. Cost 5,000. So profit 5,000. And income statement of the target company. Sales 5,000. Cost 3,000. So this includes depreciation. Then 2,000 is the profit. And then they also paid dividend. Dividend paid 500. Okay. And then incorporate.
Sir, this dividend paid is 500.
Yeah. Incorporate target company's income statement impact. Target company's income statement impact on acquiring target company's income statement impact on acquirer company. On acquirer company. Then next, reflect appropriate changes of acquirer's balance sheet. Okay, this is the question. Yeah, have you written it down?
Yes, sir.
Okay. So you just take a minute, go through the question, then we will solve it. Okay.
Okay.
Just read it, go through the question.
Done, sir.
Done? Okay. So now acquiring 25 percentage. That means what category it falls under, first of all? Is it investments, financial investments that less than,
Association one, second one.
yeah.
If they are influencing,
Yeah. So here nothing has been given, na? So we will
yeah.
go with the number only. So it
Okay.
will not be financial investment. This is second one. That second one is called investments in associates. Investments in associates. Third one is control, and fourth one is joint venture. Okay. So this is investment in associates. Investment in associates is what? Equity method. So equity method, how do we do? So first step, prepare balance sheet of the acquirer post acquisition. So immediately after acquiring, what is the balance sheet? So we acquired it for 9,000 rupees. Okay. So, and 25% shares we have acquired. Okay. So here, so I am making acquirer's balance sheet. First question. Acquirer's balance sheet. So how you should do, first I'm just copying all what I wrote before. Retained earnings.
3,000. OCI 3,000.
Yeah. Then
Minority interest 2,000. Bank loan 7,000.
total
20,000.
Okay, right hand side.
Go to bed 3,000.
Then
Building 2,000
okay,
and cash 15,000.
I have just copied it, right?
Yeah.
Now only one step I have to do. This equity method of accounting is also called single line of accounting. Single line of accounting means what? I paid 9,000 to buy this company shares, and I said like that is called as investment in associates. So I'm going to mention here investments in associates. which is what, 9,000. But this 9,000 to get, I have paid by cash. So
Cash will be
minus, yeah, 6,000. So this will become 9,000. Finally, it will be remaining at 20,000 only.
So why you
So
minus 6,000 only
9,000. Sorry,
as you?
sorry.
Oh, yeah,
9,000, and then it will be 6,000. So total will remain
same.
20,000 only. That's it. This is the answer for the first question.
Okay.
So first you write down this. We'll do one by one, otherwise it will be confusing. So you write down this and you understand this. This is the first question's answer.
Yes, sir.
Then we'll move to the second question.
Done, sir.
Okay. Okay. So now next question. So question 2 is what? Decompose the purchase price of 9,000. That means, see, when you are purchasing something, you might have paid them more than the market value. Okay, more than the fair value of the company. So we have to find out. That means when you are buying a company, you might pay little more premium, which is called as goodwill in
Yeah.
accounting. So we have to find out if there is any goodwill or not. And they are saying decompose. See, normally you know how to calculate goodwill. So goodwill is equal to
Yeah. Extra
uh,
money we paid other
correct.
than assets and liability.
Yeah. So identifiable net identifiable fair value of the company minus uh, minus the amount that we have paid. Okay, paid amount. Okay, that means we have paid how much? 9,000. Now we have to find out net identifiable fair value. Now this net identifiable fair value can be categorized into two types. One is net identifiable book value, and extra amount, excess over book value. Together will become fair value. Is that okay?
Yeah.
So net identifiable book value, we will again go back to the balance sheet of the target company.
Mm.
So this is the book value,
Yeah.
and this part also.
So,
Okay. This is not an identifiable. This is
okay.
unidentifiable asset.
Yeah.
So land, building, inventory minus bank loan.
Mm.
So land, building, inventory minus
Thank you.
bank loan. So land, building, inventory is how much?
8,000.
2,000, 2,000, 4,000 minus 6,000. So 2,000, 2,000,
4,000.
4,000
Now minus 6.
minus 6,000.
Total 2,000.
Total comes to 2000. And excess value, see, from this 2000, our share is 25%. So our required amount is 500. Okay, excess over book value means what now? Now, because we have to see what is the market value of this company. Extra 10,000, and here 10,000, and here nothing. So 10, and then, yeah, then here also nothing. So 10,000, 10,000. No, this is 8,000. Extra 8,000 we are paying.
Yeah.
Here extra 10,000 we are paying. 8,000 and 10,000. So this part is
So it means we are paying market value.
yeah, market. We will calculate based on the market value.
Okay.
Okay. Uh, so land is 8,000 extra. Building is 10,000 extra. So overall extra is what? 18,000.
18,000.
So this 18,000 also we have our share of only 25%.
4,500.
4,500. That means overall we are supposed to pay how much?
5,000.
5,000. But we paid how much?
9,000.
9,000.
4,000
So
extra.
yeah, so that means that we have paid 9,000 here. So 5,000 minus this one. So that comes to 4,000 extra. That 4,000 is only called as goodwill. Okay. This goodwill is a plug-in number, plug-in figure. That means just the remaining amount we will calculate as goodwill. Is it understood this part?
Yeah.
Now you write down all this properly.
Done, sir.
Okay. Now third question. Third question, they say end of the year, this is the income statement of the acquirer and income statement of the target. Incorporate target company's income statement impact on acquirer's company. Okay, so first we will write this question again. Okay. So third question, income statement of the acquirer first. So it is sales 10,000, cost 5,000, profit
for target, it's sale 5,000.
Yeah. Sales 5,000.
Cost 3,000.
Dividend paid is 500, correct?
Yes, sir.
So now how do I inculcate this part here? So because I have invested and I own 25%, so I will take 25% share. So plus proportional profit. So that will be how much? Because 25% belongs to me. So 2000 into 25%. Let's calculate.
It's 500.
500. Okay. Now, while taking the profit, there is one more thing that you should be careful about. That is, now profit will come. Another one is depreciation. Why depreciation? Because remember, we have taken market value of the assets. So
Yeah.
that means we have taken, see, land is not depreciable. So leave that one.
Hmm.
Here, 10,000 extra we have taken.
Yeah.
Because this 2,000 depreciation is already they must have given. Remaining 10,000 that we have added, no?
Yeah.
Okay. So what do we do for that? So 10,000, and see, depreciation is straight line method depreciation for 10 years. That means each year it will be now 1,000.
Hmm.
In that 1,000, so you understood 1,000 how?
Yeah, 10,000 divided by 10.
But our share is only 25%, no?
Yeah.
So 12,000 minus 2,000. So that is equal to 10,000. This 10,000 is for 10 years. So 1 year depreciation each year.
It's 25% is 250.
Yeah. So 1,000 depreciation each year. But we want 25%. So 250. So minus 250. Okay. So this is the takeaway point. This is called what? Incorporating the income statement of the target company in the income acquirer's income statement. So this is the third question. Incorporate target company's income statement impact on acquired company. There is no effect of dividend. Dividend we are not going to handle here in the income statement. Okay. So two things you have to remember: proportional profit and depreciation. See, proportional profit automatically strike your mind. What people will forget is the depreciation. So that you should not forget.
Okay.
So the questions will come like this only. So they will say, like, overall, what will be the impact in the income statement? So overall impact is addition of 250. Okay. Now you write this one. I'm giving you all full-fledged questions so that once you practice this rigorously, these textbook questions will become easier then.
Yeah. Done, sir.
Okay. Then next is fourth one. So fourth one is balance sheet. Acquirer's balance sheet. What is the change? Okay. So again, first I'll write the balance sheet as it is. So as it is means first initially what is our balance sheet? It was acquirer's balance sheet. Then we will make the changes.
But sir, we have made the acquire balance sheet, right?
Initially. Now, end of the year, we got some profit, no? So now we have to make some changes.
So
So
that
equity,
250 profit we have to add.
that one, correct. Retained earnings, 3,000. OCI, 3,000. Minority interest, 2,000. Bank loan, okay. This time I will not add up all this, or it's okay. Now see, goodwill, 3,000. Building, 2,000. Then cash, 15,000.
So we will add that investment in association also in this, right?
So now, not this was 6,000, no?
Yeah,
And investments in associates.
9,000.
This was the original one. It was like this.
Yeah.
Now we will make some changes. See, now first of all, what changes should we make? We got proportional profit. The value of our investment has gone up now, right? So proportional profit. How much? 500.
250.
And then,
Depreciation.
no, not depreciation. 1 minute. This is, yeah. Okay. So proportional profit minus depreciation, 250. Okay. So that part I'm writing here as well. Okay. And left hand side also, if you want, you may write plus OCI 250. This one extra. Okay. Then, but this is not required now. Right hand side is important. Okay. So there you focus. Then another transaction, dividend. Now we cannot ignore it. Dividend 500 received. So if you have received dividend, then the cash will go up, na? But
Yes,
did you
sir.
receive all 500?
No,
No,
25% of
25
that.
percentage. Yeah, calculate that one. 25 percentage of
125.
500. So 125 only we received. But if we are receiving 500 or we are receiving dividend is coming from profit only.
Yeah.
So that means the profit will come down. Na? Here I am showing that I am receiving all 500 profit. But I cannot receive dividend as well as profit. If I am receiving dividend, then my profit would have gone down.
Okay.
So minus dividend received is what? 125. Okay, minus. So calculate this total.
Nine 125.
Yeah. Okay. Now if you want, you calculate all right hand side. Yeah. This much only done. Okay,
Yeah.
but just if you want to calculate all the right hand side and left hand side, you may calculate. It will come another number, but it will match. Is it done?
Just calculate it.
Yeah.
Yeah, some matching.
Mm.
It's 20,250.
Yeah, but you don't have to match all the time. This time it is okay. Why you don't have to match all the time? Then you will get more doubts. Why? Because then you will ask, like, where is this 5,000 gone? So this 5,000 also should come into the
Yeah.
balance sheet. It should come. Then all other transactions also then will change. But right now we are ignoring all this and we are just focusing on, based on this investments in associates, what are the changes that are happening.
Okay.
Only that part. Okay, so this is what the questions will be like. So they will ask you, what is the balance of investments in associates, like this they will ask you. So dividend received. Okay, so now you write down this question properly.
Yeah, sir. Written.
Written already? Okay.
Yeah.
Okay, fine. So this is it. Now we'll do one more question like this. So later on at home, what you have to do is you have to keep on practicing all this. Okay.
Okay, sir.
Second question. So again, equity method of accounting. Okay. Acquirer, $50,000. Then goodwill, 10,000. PPE, 20,000. Cash, 20,000. Then acquiring, equity, 4,000. Bank loan, 1,000. PPE, 1,000. Inventory, 1,000. Cash, 3,000. Its fair value is, and this is 10,000. Okay. Fair value is 11,000. Depreciation is 20% per annum. on book value. Then, so this acquirer is acquiring 30 percentage at 10,000. End of the year, acquirer's income statement. End of the year, acquirer's income statement is sales 5,000, cost 2,000, profit 3,000. Then acquiree's income statement. Sales 1,000, okay, written all this. Hello.
Yes, sir. Better.
Okay, all written. Okay. So we'll redo again. Okay. So first step is what? First question is prepare balance sheet after acquisition. So first step is immediately after acquisition. What is that? Single method of accounting.
Yeah.
Okay.
Just we have to add that.
Hmm. Yeah. So first one. So first I will write copy paste the balance sheet as it is. Okay. So acquirers balance sheet.
Equity 50,000.
Equity 50,000.
Goodwill 10,000. PP 20, yeah. Cash 20. So, but they haven't given that share, how much share we have taken.
Amount is not given. 10,000.
That, acha, 30, this haven't written, 30%.
Hmm. Okay. So here investments in associate. Okay. So I will write investments in associates. How much?
10,
30,000. How much?
10,000.
10,000. 30% at
Yeah.
10,000. Okay. So I will 10,000. So that has to go from my cash.
Hmm.
So minus 10,000. So balance all will remain the same. That's it. Over for the first question.
Hmm.
The second one now.
Take up this purchase price.
Second one is decompose the purchase price of 10,000. So 10,000 can be categorized into three parts. Book value of net identifiable assets, excess over book value, and then goodwill. So book value of net identifiable assets.
PP is 10,000.
Yeah.
Inventory 1,000.
Yeah. So all these and this
Cash will
part.
also come.
Cash will also come. Why not? Only goodwill will not come. PPE inventory cash minus bank loan. PPE
Last and cash.
inventory cash minus bank loan.
10,000 plus 1,000 plus 3,000.
10,000 book value plus
10,000
1,000
inventory. 3,000 cash. Bank loan 1,000.
3,000 cash. Bank loan is what?
1,000. Total
1,000.
13,000.
Out of that, our share is
30%.
30 percentage.
3,900.
So excess over book value is only, I think,
1,000.
property, plant and equipment.
Yeah, only 1,000.
1,000. Okay. 1,000 and within that 30 percentage.
300.
So this total comes to 4,200
Yeah.
minus 10,000. How much?
Minus
10,000 out of 10,000.
5,800.
So 5,800 is our goodwill. Okay.
Yeah.
10,000 minus 4,200. This is 4,200. Okay, done. Second question is over.
Yeah.
Now the third one. What's the third question? Okay, end of the year. Incorporate target company's income statement. Okay, first we will write this as it is. Okay,
Yeah.
income statement. Income statement of the acquirer. Income statement of the acquirer. Sales 5,000. Cost 2,000. Profit 3,000. And then income statement of the acquiree or target, one and the same. Sales
1,000.
1,000.
Cost 300. One 40.
Okay, so now I will continue the income statement, right? So two things, remember, profit and depreciation. So plus proportional profits. So proportional profit is 700, and so
700. 30% of 700.
so that is
9.
210. 210, na?
Yeah.
Then what is the next one? Depreciation.
Depreciation.
So
Depreciation.
depreciation is market value
20.
1,000. Depreciation per
20%.
so thousands 20,000. Thousands 20 percentage
2,000.
is no. Thousands 20 percentage is 200.
So why for 1,000 only?
This is 10,000, na?
Yeah.
And this is 11,000. So
That's okay.
excess
We have
value
to
is
take
only
difference.
the excess value, because for this 10,000 they must have already done.
Okay.
Okay. So 200, and within that also our share is only 30 percentage. That means what? 60
60.
rupees.
Yeah.
So 60 is the depreciation. So depreciation 60. So I'll write here 11,000
150.
minus 10,000 into 30 percentage, and in that, so that comes to 300. In that also 30 percentage. Achha, 30 percentage or what? We have taken 30 percentage, right?
We have taken 20%, then 30%.
Okay, 20 percentage. 20 percentage. That comes to 200
Then
into
30%,
30
that's
percentage
60.
is 60.
It's 150.
So this is 150.
Now we will deduct that also, no? Cash dividend. Sorry, add.
That is
30.
in the balance sheet.
Okay.
Cash dividend is a part of balance sheet, no? Okay, let me just check the answer once. Wait. Yeah, correct only. Okay, so till here it is fine. Now,
Now last balance sheet
yeah, balance
at the
sheet.
end of the year.
Yeah. Okay, we'll do the last part. So last is balance sheet, right? So first we will write the original balance sheet as it is. So acquirers balance sheet.
$20,000.
Then
Just investment association is 10,000. And like the profit in it. So investment in association is 10,000, no?
acha, oh, that was 30 percentage, right? Okay.
Yeah. Plus 210 profit
Cash
proportion.
is how much? 10,000, correct?
20, uh, cash is 20,000.
No, that was
Yeah,
initial
10,000
in
left. Yeah, 10,000 left.
left is 10,000. Okay. So 10, 20, 10, 10. So 10,
Then,
20, 10, 10. Okay.
well, then we'll add 210 of proportion profit.
Plus proportional profit. So here three things we have to change. Okay.
Yeah,
Proportional profit, depreciation, and dividends.
yeah.
So proportional profit is 210 minus
Depreciation is 60.
depreciation 60. Okay. Then cash dividend we are receiving.
140. And
No.
30% of that is
30 percentage only.
42.
42. Okay. 42. 30 percentage. So dividend received 42. And here dividend received, I will minus it, 42. So this is
10,000
the balance.
plus 210 minus 60 minus 42. 10,108.
Overall,
No, sir, for investment in
only
associate.
okay,
Yeah.
10,108. Okay, yeah, right. Yeah. Ten thousand 20. Yeah, right. Okay. Now, if you want, you may check also. Ignoring their transactions, we will ignore. We'll take only. I mean, there means this companies. This 3,000 we will ignore.
Okay.
We will take 150 if we take here retained earnings 150 and this amount. Now you check both the sides matching or not.
Yeah, so matching.
Okay. Just 1 minute, I'll drink water.
Yeah.
Okay, now some more calculations. So this sum is done, but some related calculation. See, net profit margin of acquirer ignoring acquiree transaction. Net profit margin of acquirer ignoring acquiree transaction. So what was their sales? Their sales was 5,000 and profit is 3,000. I'm ignoring this acquiree's transaction. Okay. So net profit margin will be 3,000 by 5,000. Is it okay?
1 second, can you repeat this one?
Net profit margin of acquirer ignoring acquiree transactions. So what is the formula? Net profit margin is net profit by sales,
Yeah.
ignoring acquiree transactions.
Okay, understood.
So that is calculate.
%60.
Now net profit margin considering acquiree's transaction.
So we have to add 30% of 700 we will add.
Wait. Here sales will be same 5,000. Okay. Now net profit will be 3,000 plus 150. Na?
Yeah.
So 3,150.
Precision. 63%.
So moral of the story is what? Observation.
Net profit margin increases.
net profit margin. If there is profit, what if the target company has given you losses? Then it may be negative also. It may be, it may go down as well. But then the point is, so that means equity method of accounting increases or decreases net profit margin, because in this case it increased, but if this would have been loss, it would have decreased. So increases or decreases net profit margin. However, it does not affect sales. Sales will not get impacted. Okay, sales is remaining the same, no? 5,000. Clear? This is okay?
Yes, sir.
Okay. Then next one. Okay, based on this, I'm just continuing now. But you practice this and then we will do the book sum. It will be very easy. Okay.
Yeah.
Because if I directly again continue book sum, you need time to practice also. No?
Yeah.
Okay. See, now there is something called upstream and downstream of transactions. Okay. That means when I say upstream, that means goods going from investee to investor. Goods going from investee to investor. Okay. So goods going from investee to investor. So let's say, for example, so this is investor and this is investee. So this is upstream, going from investee to investor. Now imagine investor is owning proportional ownership of 30%. So now, so this investee sold goods to investor company for 10,000 of 6,000. So that means this is what sales amount, and what is the cost of that sales?
6,000 profit.
6,000. So in this case, now you see they can easily manipulate investor investee. Now they are partners kind of thing, right? So now investee is selling goods to investor, so easily he can increase his sales then.
Yeah.
Okay, and he will show more profit. But now the problem is, investor, imagine, is he able to further sell it or not? So let's say investor, okay, investor further sold 60% of those goods. So that means he has sold only 60%, remaining 40% is with the investor only. But investee, it is like things are moving. The goods are, instead of with the investee, now it is with the investor. But investee will say like, I have sold goods, and he is increasing his profit. So that should not be allowed. That means now investee has to reverse his profit. Okay, he is showing more profit now.
Yeah.
Because whatever he has sold to the investor has not sold all. He has sold only 60%. 40% is pending. So 40% of the profit is what? That's what we need to find out. See, 40% of the profit means this is 4,000 rupees. The difference is all about 4,000 profit. In this profit, the problem is 40%. That means 1,600. In that 1,600 also, our share is only 30%.
Okay.
Okay. So that calculate how much it comes to. Is this 40%?
480.
480.
Yeah.
So reversal of profit will happen. Reversal entry of profit of reversal entry. Reversal entry of profit. Okay. Reversal. So investee will reverse. Reversal entry of profit. How much? 480. So if I give it like a formula, how it will be, sales minus cost into unconfirmed. Unconfirmed, okay? This 40% is unconfirmed, no?
Okay.
Unconfirmed into proportional percentage.
Like, so 40% is with them only, with their company. That's why. And they have
So,
sold 60% to further.
so that means extra 40% investee cannot show that as their profit.
Okay. It's the software. Just, so 60% of those. Of 4,000. 50% to 50. Invest. So what you have written, sales minus cost into unconfirmed into
Into proportional percentage, proportional ownership percentage.
so can you explain this one again? Like why you have multiplied 30%?
See, this is 10,000
Yeah.
sold minus 6,000. So the topic is all about 4,000 extra profit. But in that 4,000 extra profit, 40% is not sold only. So 40% profit I should reverse. In that 40% profit, my ownership is, because I have sold. See, this is an internal thing. See, suppose imagine they both are completely unknown to each other and he is selling. Will investee be bothered whether investor has further sold or not? No. But here, so that means they have to be bothered till 40%, till 30%.
Yeah.
Okay, so that's why that 30% of this entire amount they have to reverse.
Okay.
Is it okay? Done?
Yeah, sir.
Okay. Similarly, we'll do just one more. Downstream. So again, investor sold goods. So downstream means what, first of all? So downstream, investor and investee. Now investor is selling to investee. So investor sold goods for 50,000. Okay, of 30,000 to investee. Okay. Then investee further sold 80% of those goods.
The treatment will be same.
Same. So again, same. The problem is of this 20,000.
20%.
So sales minus cost. So which is 50,000 minus 30,000. So 20,000.
Of
From this
20%.
20,000, unconfirmed is what?
20%.
20%. So unconfirmed. So into 20%. Out of that, so
30%.
out of that, our share is 30. So investor now he has to reverse. The one who is selling now, that person has to reverse because he is going to show more profits.
Reversal profit is 1200.
Correct. Proportional ownership. This much will be reversed by the investor. Okay.
So
Done?
can you just tell me that paper pattern of CFA level 2? Level 2 paper pattern like case, it's all case study.
Yeah,
Or
full
MCQs will
case
also be
studies.
there.
No, all case studies. Within that case studies, MCQs questions will be there. Okay. Again, you will have 44 questions in morning paper, 44 questions
Okay.
afternoon. Okay.
Okay.
Wait, I'll just stop the recording and I'll explain all this.